If you have spent time in trading communities, you have probably seen charts covered in colored boxes labeled order blocks, liquidity, and fair value gaps. This is Chapter 1 of the SMC and ICT module. The big institutions leave footprints, and these two frameworks try to read them. So what is smart money? Here is one price cycle, with smart money on one side and the retail crowd on the other. The wave runs across the middle. On one side sits one big player. On the other, many small players. The big player accumulates, buying the lows. Then it distributes, selling into strength. The crowd gets trapped, buying the top. And then it panic sells, dumping the lows. Follow the arrows and the pattern is plain. The central premise is that price seeks liquidity. Smart money buys when the crowd sells, and sells when the crowd buys. Retail chases the move while smart money fades it, and price is drawn toward pools of resting orders. So who exactly counts as smart money? The phrase means the largest and best-informed players, banks, funds, and market makers. That is what smart money really means. It comes down to size and information. On one side, large size and better information. On the other, small size and public information. Banks come first, meaning central and commercial desks. Then hedge funds, with large discretionary capital. Then market makers, who provide the liquidity. Against them sits the dense retail crowd. Set the two side by side, and it is few against many. Smart money is a few very large, well-informed players, while retail is many small players trading on public information. Follow the size and the information. One group has more of both. But this does not mean anyone is hunting your particular order. Nobody knows or cares about your individual trade. The grounded version of the idea is structural. Resting orders above highs and below lows pull price toward them. Price seeks liquidity. The pools sit below prior lows and above prior highs. There is the prior high and the prior low. Below the low sits sell-side liquidity, which is resting sell stops. Above the high sits the buy-side pool. Here is the path price travels. The swing points mark the turns. And when price reaches up and takes that pool, the tag marks a liquidity sweep. Then the pull is the magnet effect. On the right, the labels name it. Buy-side liquidity is resting by stops, and the magnet effect is price gravitating to the pool. Resting orders above highs and below lows act like a magnet. Liquidity is where resting orders cluster, and price is drawn to those pools. Where did this vocabulary come from? The framework belongs to one trader, and the wider community built on it. Where ICT came from. One trader's framework on one side, the wider community on the other, and the path between them. It began with the inner circle trader, the teaching name of Michael Huddleston. From that came the concept chips, kill zones, the Judas swing, optimal trade entry, order blocks, and liquidity. The lines fan out from him to those chips. Then the community absorbed them and renamed them. The chips converge into that hub. And the bold arrow says it plainly, adopted and renamed, the same tools under new names. It is one trader's toolkit, repackaged by the community under fresh labels. Treat the names as shared vocabulary rather than rival systems. So how does any of it sit alongside what you already know? You do not have to abandon everything else you know. Keep your classic tools, because this adds a liquidity lens on top. One chart, two lenses. Classic analysis says what and where, and the newer lens adds the why. On the left, classic technical analysis, support and resistance, trend lines, moving averages, and chart patterns. On the right, the liquidity lens, liquidity, order blocks, fair value gaps, and kill zones. Both feed into the result, which is a fuller read of the same chart. The left column feeds in. The right column feeds in too. And the plus signs make the arithmetic explicit. Two toolkits, one price chart. The classic tools mark the levels, and the newer lens explains what draws price to them. You are layering a lens on top of what you already use rather than replacing it. That said, there is a caveat worth stating plainly. Here is the part many tutorials skip. These are lenses for reading a chart, not a guarantee of profit. An honest framing before you start. Call it a reality check, and set expectation against reality. First, tools, not magic. It is a framework for reading price, with no guaranteed edge. Second, no proof of guaranteed profits, because no peer-reviewed study promises a sure win. Third, think in probabilities rather than certainties, since any setup can fail and you weigh odds rather than outcomes. Fourth, risk management decides survival, because what you risk per trade matters more than any signal. Now look at the equity curve. Expectation is a smooth straight line upward. Reality is a jagged path that only drifts up. The legend names the two. approached with clear eyes and firm risk limits. These ideas help you read a chart, and they never remove the risk. Treat it as a lens, think in probabilities, and let risk management decide whether you survive, which is where the toolkit itself begins. You just finished Chapter 1 of the SMC and ICT module. Smart money means the largest and best-informed players. The central premise is that price seeks liquidity. The vocabulary came from one teacher and spread, and it layers on top of classic analysis rather than replacing it. No chart method removes risk. Any trade can lose. Sequences of losses are normal, and this is education rather than financial advice. Thank you for watching Trendly Lab. Next up, Market Structure Explained, covering break of structure, change of character, and reading trend.